Definition of money. Money is anything that is generally accepted as a medium of exchange in economic transactions. Throughout history, money has evolved from the barter system, to commodity money, and finally to modern forms of money. Characteristics of good money. Acceptability. Widely accepted in transactions. Portability. Easy to carry. Durability. Does not wear out easily. Divisibility. Can be divided into smaller units. Stability of value. Maintains purchasing power over time. Security. Difficult to counterfeit. Functions of money. 1. Medium of exchange. Facilitates transactions by eliminating the need for barter. 2. Unit of account. Measures and compares the value of goods and services. 3. Store of value. Preserves purchasing power for future use. 4. Standard of deferred payment. Used to settle debts or obligations over time. Types of money. 1. Based on physical form. A. Currency. Physical money issued by the central bank, coins and banknotes. B. Demand deposits. Non-cash payment tools like checks, debit cards, e-money. 2. Based on material. A. Coin money. B. Paper money. 3. Based on value. A. Full-bodied money. Intrinsic value equals face value. B. Token money. Intrinsic value less than face value, e.g., modern paper money. Definition of inflation. Inflation is the condition where there is a continuous and general increase in the prices of goods and services over a period of time. It reduces the purchasing power of money. Characteristics of inflation. Affects prices broadly across the economy, happens over time, not just once, weakens consumers' purchasing power. Types of inflation. 1. Based on severity. A. Mild inflation. Less than 10% per year, manageable. B. Moderate inflation. 10 to 30%, noticeable impact. C. Severe inflation. 30 to 100%, harmful to economy. D. Hyperinflation. Greater than 100%, economically destructive. 2. Based on causes. A. Demand pull inflation. Caused by excessive demand over limited supply. B. Cost push inflation. Caused by increased production costs, raw materials, wages. C. Structural inflation. Caused by imbalances in the economic structure. D. Imported inflation. Caused by rising prices of imported goods due to currency depreciation. Causes of inflation: excessive money supply, rapid increase in consumer demand, rising prices of basic goods or inputs, increase in wages without productivity gains, rising prices of imported goods, currency depreciation, weakening of domestic currency. Effects of inflation. A. Negative effects. Lower purchasing power. Same amount of money buys fewer goods. Decline in savings value. Money saved loses real value. Real income drops. Especially for fixed income earners, unequal income distribution. Hurts low income groups more. B. Positive effects, if moderate. Encourages spending and investment, motivates producers to increase output, reduces real burden of debt over time. How to control inflation. 1. Monetary policy, central bank, open market operations, selling government bonds to reduce money supply, interest rate adjustments, raising rates to reduce borrowing and spending, reserve requirements, increasing bank reserve ratios to limit credit expansion. 2. Fiscal policy, government, reducing government spending, increasing taxes to reduce consumption. 3. Non-monetary measures, boosting domestic production, improving supply chains and distribution systems, ensuring political and economic stability. The role of Bank Indonesia in controlling inflation, setting annual inflation targets, managing the stability of the rupiah exchange rate, supervising and regulating banks, providing a safe and efficient payment system, issuing independent monetary policies to maintain macroeconomic stability. Conclusion. Money plays a vital role in economic activity, but if its supply exceeds economic growth, it can trigger inflation. Uncontrolled inflation negatively impacts society and the economy. Therefore, proper coordination between the government and the central bank is essential to ensure price stability, protect purchasing power, and maintain economic growth.